Yeah.
Okay, well, let's make a start and the others can catch us up. So remember last week you took a look at the first interview on James the Grocer, as part of our client relationship skills module, and we talked about the importance, of telephone calls, of managing your time, of interviews, and particularly with interviews and meetings, trying to do some homework and preparation.
This thing shaking bad.
Somebody else has just come on there. We got background noise from your lady, Miguel. Okay, so I was saying about the importance of preparation for the meeting. So the purpose of this, yes, it's old, but it's got a very powerful message from the Institute of Bankers video from quite a few years ago. You'll see the first interview where the security clerk, he does his best, but it's clear that he doesn't really understand the accounts, and part of our mission on this module 2, particularly, is to get a good understanding of what we're looking at, which will help you, with the relationship skills, because his relationship outcome was a disaster, as you could see, because the customer, who'd been with the particular bank for 20 years. Do you remember what he said towards the end of the interview? Anyone come in on that? End of the first interview, what did he say?
He said he'll take his business elsewhere.
Yeah, definitely. So that was a disaster, wasn't it? So here you have a situation, where a customer's making a request and probably coming in, with the expectation he's going to get a favorable hearing because he's been a customer, for 20 years or more. And what happens, the outcome of the meeting, as far as the bank that's they're concerned, is a disaster, because they're going to lose the customer's account, and they're going to lose the opportunity of maybe helping them finance the premises next door, if it could be looked at in a more constructive way. And one of you kindly said last week, well, as financial planners, we need to try and look at this and see if we can help and be constructive in some way. So let's take a look at the homework that he could have done if he'd had time to prepare himself properly. And then what we'll see is the bank manager taking the second interview, and you'll see he's done a lot of homework, and let's see if his homework kind of coincides with ours. So just before we start the film, the second part, you can see the ratios on the screen there, and Miguel's also putting them in the chat box as well. But for the moment, there they are on the screen, and you can see his sales growth, 13.3, then 16.1, which is quite a reasonable growth when you think food retailing is quite competitive. His gross profit margin, yes, it is sagging a bit, as the security clerk pointed out, but we would need to ask a question on why, and does the customer realize this and what's going on with that? There could be a jolly good reason. He could be discounting some of the selling product lines, or he could be having to, decrease selling prices to match competitors, or he may be paying more for the goods, that he's getting in, and he's not passing on the increase in sales price. But we need to find out why. And then coming down, you can see the operating margin, which is PBIT, if you remember, profit before interest and tax, or using the US version, because I'm sure occasionally in Nassau you're going to get, some American style accounting presentations. So that's EBIT, earnings before interest and tax. And then that's the same as the pre-tax profit margin. Why? Because there's no interest being paid at the moment. And then down to the bottom line, the net profit margin, well, you can see it's quite fine. I mean, it's less than 1%, but the good news is it is improving from 0.5 to 0.7 to 0.9. So I know it's only still small, but it is improving. Any questions just on that first bit, or are you comfortable with that? Everyone okay on that first bit? So that's, quite a deep dive into the income statement. And if any of you later, want to go on the internet and download one of your favorite companies, from media relations or whatever on their website, and I mentioned Walmart, you could do that if you wished, or other businesses. You can use the same technique on the large companies. And any persons on this program who later might want to progress onto the wealth manager, which Miguel's just advertising now, you'll see on the wealth manager program, we look at some large corporates and we use the same ratios, but we enhance them by adding in some stock market ratios. Miguel, we're still getting background noise from somebody talking to you there in your office. And then into the liquidity. Now you can see, as the security clerk pointed out, the liquidity is in adverse position, but look, it is improving, isn't it? It's 16,000 negative to 9 to 1, and the actual current ratio, which he was talking about, has improved from 0.7 to 1 to 1 to 1, but more on that a little bit later when we start to move in to, to the cash flow analysis side. Debtor collection or receivables, well, that's quite quick, and we'd expect that because, you get to the till you pay. Stock level, this is all of the stock, all of the inventory in the store, so turning over quite quickly, 3 weeks, and just a little bit longer than that. So that could provoke a question again to the customer. We see your stock turns slowed a little bit, you might have comment on that. And it'd be good when you're in discussions with the client, when they can give you feedback on certain things that you're asking. I mean, if they have no idea what the stock turnover is, that points to, to maybe a poor management positioning, that they don't know what's happening. Then there's the payables, the creditors, 48 days, 46, 47. So quite steady, paying, about a month and a half. So a good question there would be, what are the terms of trade with the creditors? So these are the creditors, these are the people who are supplying the goods to James the grocer to go in the shop, on the shelves. So a really key question really is, what are the terms of trade? Now often you'll find terms of trade are 30 days. Now, if it was 60 days, well, he's paying ahead, of when he needs to. If it's 30 days, well, he's paying a little bit later than he should. But I mean, it's not taking it to an extreme position. Asset efficiency, I mentioned this is hardly ever used. I quite like it. It gives you an indication of the progress of the business. So 5 times sales relative to the total assets that's employed in the business looks quite a high figure, and also it's quite stable, as you can see. So again, pointing to some good management. Return on equity is not applicable on this smaller case. Interest cover, well, there's no interest charge. Leverage is all the liabilities, so that's quite steady, about 200%. And debt gearing, that's the favorite banker's ratio globally, sometimes called debt equity, sometimes just called gearing ratio, sometimes called debt gearing. And that's not applicable because there's no debt in the balance sheet at the moment. So any questions on that just before we play the video, and then we'll see, how the bank manager handles this interview, so differently to the security clerk. Any questions, or everybody reasonably comfortable on that? No questions, so we seem to be okay. As I mentioned last week, these things take time, and when you've done this a few times, you'll start to, get used to it. You'll see the power of it, and then, you can look at other businesses and have a go yourself at analysing them. Okay, Miguel, we're ready. We're ready for the video now, please. So I'm going to stop sharing. So you might have to put your sound back on, Miguel.
Yeah, I have my sound on. I'm going to try to turn it up as much as possible.
Okay.
1 second here. I have my sound on maximum. And I'm going to play it. Please let me know if you can hear it or if it's okay.
Mr. Jackson? The manager available? I'd like to ask him about a loan. Oh, I'm sorry, he's not in this week. He'll be back on Monday. Would you like to make an appointment to see him then? Yes, that should be soon enough. Yeah. Could we make it afternoon on Monday? Would 3 o'clock suit you? Yes, that's fine. If you have any accounts or papers with you, would you like to leave them with me now? Mr. Moyes likes to be prepared on these matters. Yes. Thank you. Nice to see you again, Mr. James. Take a seat, please. Thank you. Must be well over a year since I last saw you. Yes, unfortunately, in these difficult times, I have to spend a lot of time with customers who are having trading problems. But it's nice to meet a customer who, judging from our figures and your own audited accounts, has had such a good year. You've been through the accounts? Yes. Figures make much more interesting reading. And in your case, tell a very cheerful story. Oh, well, my accountant said it had been a good year, but I thought he was just chatting me up for an increase in his fees. What I wanted to ask you about was the possibility of the bank. That's what we're here for. Tell me what it's all about. Well, as you know, I'm in number 17 and 19 for Slovakia, but number 21 has just become available. Because the old boy who owned it has died, and his estate all goes to some great niece out in New Zealand. Well, his executive dropped in the other day, asking about the mail, and he told me that someone had to take a lot of them. If I got in there, if I was interested, I could possibly save the cost of the auction. So you thought that although you prefer to rent it, there's no chance of it. And if you're going to expand into the third shop, you've got to buy it. Presumably we're talking about your company. Yes, that's right. Yes, have you thought about planning permission? You're proposing to change a paint shop into a supermarket. Well, I've had a word with my surveyor. He's talked to the chief planning officer of the town hall, and there's no problem on that point. Good. So what sort of price would the executors want? Well, my surveyor reckons it's worth about £75,000. That's the top price he can get. Yeah. And you'd be looking to us for the whole amount. I'm afraid that's a bit more than we want to go to. Well, I knew you'd expect me to make some contribution, so I've had a word with my old mother. She's over 80 now. She's the life tenant of the family trust fund that comes to me when she dies. She's quite happy to have the trust broken now. I think she might buy an annuity with her part. My solicitor reckons I should get about 30,000 out of it after taxes and expenses of it. And that would be your own money and interest free. Yes, that's right. Well, I've never had any income from it in the past, so I'm not likely to miss it in the future. If the bank were able to help you with the rest of the purchase price, you'd be willing to give us a first mortgage on the title deeds? Oh, yes, of course. Right, well, we're talking of a balance of £45,000 for premises. Plus, say, £3,000 for legal fees, survey, stamp duty, and everything else. And, of course, you'll want to join it with your existing shops. Any idea what that might cost? Well, the doors are in the right place, and the floor seems level with mine, so it's mainly a matter of knocking down the dividing wall and fitting in the new safety board, you see. Well, there's some plumbing work and electrical work to be done, but I think £2,000 should cover that. And what about shop fittings? Presumably you want to match it in with your existing equipment. I could set you back a bit. Yes, I had a quote from the shop fitter with a shop at £6,000. But that does include some freezer units and refrigerated display units. So that's £56,000 we'd be looking for. Yes, give or take 1,000, I suppose that's right. And with interest at 17% today, that will be nearly £9,000 we'd be charging you in the first year just for the interest alone. And then there'd be capital repayments on top of that. Now, this last year was your best year ever, and your profit wasn't even 8,000. Does that mean you're saying no?
No, not yet. Don't let's be too hasty. We don't judge a business on a single figure of profit. There's much more to it than that. Let's look at your profit and loss accounts carefully. Some things here I'd like to understand a little better. Yes, here we are. This one here, bus advertising. What was that?
Oh yes, I took a whole bus advertisement. That's when you have the bus painted up in your own colours. They quoted me £6,000 in 1 year or £12,000 spread over 3 years. Well, I reckon it was a bargain to have 3 times as long for every twice as much money, so I opted for the 3-year contract with £4,000 a year.
It's nice to see those 3 years an hour.
Yes, they've already repainted it. Didn't give me a week over the time.
So you've lost your pink bus then?
Yes, afraid so.
Well, that may be the town's game. I must confess I never did enjoy looking out of that window when the pink monster went by saying James for a choice in cheese. But that's good.
Oh, I'm sorry if it's offended you in any way.
Oh, no. When I said that's good, I meant it helped these figures. Presumably you've had the benefit of the advertising, so next year, instead of making a profit of £7,823 after paying £4,000 for bus advertising, you could be looking forward to making at least £11,823.
Oh yes, I suppose I could really.
Well, did it bring you extra business? Do you think it paid off?
I think so, yes. Yes, I mean, without a doubt. I mean, the first week, going over to see how the painting of the bus was coming along, I managed to get the contract to supply the canteen over there, the bus garage canteen, with groceries. Of course, prices have to be keen. I have to give them a month's credit. But I'll never have a bad debt with the corporation.
So all the debtors in your balance sheet are the corporation then?
Well, they're the only ones I give a monthly account to. There's 1 or 2 private hotels I give a weekly account, but everybody else pays cash.
Cash. Haven't we signed you for the bank's credit card then?
Well, your people try, but I can't afford to pay the bank 4% commission on credit card sales.
No, we'll have to talk about credit cards again at a later date. Presumably you'll have noticed that most of the big stores have got their own in-house schemes, and we do seem to be moving towards America, towards a cashless society. However, looking at your trading accounts for the last 3 years, I see that although the turnover has risen nicely, thanks to the big bus perhaps, your gross profit margin is sagging a little. Any comments?
Well, yes, I expected that. I mean, that was part of my strategy when I took the bus out of that, you see. That means you've got to run a supermarket, you've got to pile it high, something cheap. To get the volume, you've got to shave the margins. Well, I mean, the bus garage canteen was case in point there. I knocked off 10% of the price of what they were paying their previous supplier. It's only left me with a 5% margin, but over a year that works out quite a lot of money.
Do you see your profit margins going any lower? I mean, 13.3% is a very fine margin for any grocer. Break 1 egg in 7 and you're selling at a loss.
Yes, that's what they keep on telling my girl. No, I think the profit margin should hold between 13 and 14% in the future.
Well, cutting margins seems to have paid off in your case. In 3 years, you've got your amount of your gross profit up from 66,000 to 78,000. It's no mean achievement. But what concerns me a little is, where do you go from here? If you're going to add, say, 50% to your shop floor area, you're going to need more customers. Now you've stopped advertising. How do you get them?
Oh, that's the easiest part of all. That's why I need the extra shop. Well, you've seen this new office block along the road. Well, they've already started putting the petitioning in. I reckon in a very short time, the office staff will be moving there. In fact, I think within 3 months, there's going to be about 500 office staff in that office. Now, a third of these are going to be married women who want to do their shopping in the lunch hour. Well, the only other supermarket is over a mile away, on the London Road. So I don't need to advertise if I got them on the same pavement. What I do need is the space to serve them.
Well, I must give you credit for thinking this operation through, Mr. James. But the idea of the new shop is to make extra profit. Now let's put that on one side for the moment and see if you could afford to buy it on the level of last year's profits. Now, call that 8,000 for a start, plus 4,000 for the bus advert that won't recur. That's £12,000. Now that would be enough to cover the interest on £56,000 if necessary. And of course, the depreciation doesn't really cost you anything.
I never did understand what depreciation meant.
Well, you're not alone in that. It's simply recognizing that fixed assets don't last forever. You pay for them when you bought them, so the depreciation doesn't really cost you any cash each year. In terms of what we call cash flow, that 3,150 is as much fresh cash as the profit. So what we're really talking about is an expected cash flow next year of over £15,000. Now that's enough to pay the interest and the capital repayments on £56,000.
So you will lend me the money out.
Well, just a minute. There are things can go the other way. Take your rent on the existing premises, for example. When does your lease expire and when does your next rent review come round?
Oh, I'm lucky there. I took a very old lease that was drawn up where 7-year rent reviews were the norm. I've got 17 years to run on the lease and just over 3.5 years before I need to worry about a rent review.
Good. Then let's have a look at your balance sheet again. You know, the fascinating thing about supermarkets is the way they manage without any working capital.
What?
In other words, your current assets are invariably less than your current liabilities.
What's all about that?
Well, so many businesses have to finance their customers and pay their suppliers promptly. Ties up an awful lot of cash. But in your case, you sell mainly for cash and get a clear month's credit from your suppliers. In other words, you've turned your purchases into cash before the suppliers want their money.
Can't be bad.
No. But there are a lot of people who think that because their business hasn't got any working capital, it can't be a good one. The real test is, does it work? In your case, it works very well. You want to thank your lucky stars, you don't have to give your customers credit. Selling for cash is always nice. Now, I did a few sums while I was having lunch, and I'll show you what I mean. Now, you turn your stock over in some 21 to 23 days.
Oh, I do better than that. I mean, bread and cakes are fresh every day, so is the milk.
Yes, well, I was talking in an averages, of course. I mean, possibly you can keep your washing powder for a month, but on an average, you go through in some 21 days. Now, the stock at this last date looks a little high, though. Now, why was that? Is that something different, or is the pattern changing?
Ah, you noticed that. Well, I think my wholesaler must have been short of cash to pay his tax bill. So he made this offer on John and Coffee, and I took everything he got. Well, I had to pay spot cash, but it'll give me a 7% gross margin on that. I mean, Coffee keeps all right in jars anyway. I had to pay 4,000 quid, but I got the cash. He needed it.
Well, that's very good. That's one of the values of having some spare cash behind you. But I'm wondering if you haven't got too much spare cash. See, over the last 3 years, you've paid your suppliers in an average of, say, 47 days, roughly a month and a half after their deliveries. Now, presumably that's your normal trade term.
Oh, yes. I mean, they don't offer any discount for early payments, so they get paid when it's due and not a day earlier.
Oh, that's good business. But it does mean because you're banking with us every day that you're beginning to pile up a credit balance. Now, we don't object to that. In fact, we like it. And it does mean that we don't charge you any bank charges worth talking about. But I'm wondering if you couldn't use some of that money to buy your shop with. Now, you've got £16,000 in credit in your current account today. If you use some of that, you need only borrow £40,000 from us, and you've got the money to buy your shop with.
That sounds all right, but I mean, what happens at the end of the month when I come to pay my suppliers? I mean, it just won't be there, will it?
Well, we can arrange to give you a £10,000 overdraft on your current account. Well, that should be enough, but you can have more if necessary. It means that you only pay interest when you're actually using the overdraft. That is the end of 1 month to about the 10th of the following month. By then, of course, you should have paid in enough to put the bank balance into credit again. Using an overdraft that way, it only costs you half the interest charges on a loan account of the same amount.
Well, that sounds fine by me.
Now, to come to the real problem of buying the new premises. We're going to need some sort of valuation of the premises. Perhaps you get your surveyor to get something in writing pretty quickly.
Yes, I'll get on to him later today.
And ask him to confirm that matter of the planning consent when he writes to us. And we'll need your personal undertaking that you will bring those £30,000 trust fund into the company and that you will defer any repayments of those trust funds to yourself until after the bank loan has been repaid. Agreed. And as I mentioned earlier, we will need a first mortgage on the new premises. Fair enough. You might think it worthwhile of having a chat with some of our insurance specialists in the next week or two.
Oh, you mean about the fire insurance on the new shop?
No, that's the easy bit. No, what was going through my mind was you might like to think of some pension scheme for yourself. It's a way of saving tax, because effectively the Inland Revenue treat all your contributions as being allowance for tax. I've got a leaflet here. Perhaps you'd like to look at it at your leisure. But on retirement, you can take out a large slice of the fund as a tax-free lump sum. And we could, in part, use that as a way of repaying the bank loan. However, take it.
Okay, we'll stop it now.
We stop there.
That's it, yeah. Thanks. Okay, so we can stop your sharing and then I'll put the ratio sheet back on the screen.
Hold on,
All religions teach that part of a person survives death.
hold on.
What does the body
Okay, everyone, you can hear me okay? And you can see the income statements on the screen again? Someone confirm they can see it okay?
Yes.
Excellent. Okay, so just picking up where the manager was directing the conversation. So to begin with, you know, he started with the same comment as the security clerk. When you work out the $56,000 request at 17%, it's close on an 8,000 interest alone without capital repayments. And he pointed out, you know, that the profit, the best profit figure you can see in the recent year was close on 8,000. So it looks really tight. But what he then did was he carefully looked at the various costs and the margin that was driving those figures. So he made the comment, you know, about the falling gross margin, and then the customer confirmed the reason for that, you know, was with that new contract that he got with the bus corporation. So it wouldn't go below 13 and 14%. So straight away that gave him the idea, the bank manager, the idea that if the store, without the enhancement that he's talking about, you know, without the possible expansion, if sales were around the same, say around $600,000, you know, and the margins between 13 and 14, he's going to get the same sort of gross profit coming through to meet the overhead costs. So that was his starting point. Now, this is the bank manager using what could be described as management accounting techniques, you know, which go beyond accounting techniques. Accounting techniques generally, you know, based on the information that's presented and of historical nature. Management accounting is just a very sophisticated word for any type of account, you know, that would be for management information. And as financial planners, that's what we need to keep getting at. And for example, with the John Edwards case, we wanted, you know, the management information of him producing a budget for us. So it doesn't have to be anything extremely complicated. Another form of management accounting on a small business would simply be a sales budget. So if we said, well, you know, what are sales going to be this month and the following month and the month after, you know, we might ask for a sales budget or a sales forecast. That would be a type of management information. So what he's done so far is he's confirmed that kind of top line position. And then what he's doing next is he's looking at the major costs, which we can call the fixed costs or overhead costs, whichever term you prefer. Some people call them the indirect costs, but generally they're called overheads or fixed costs. And he asks, you know, about the rental position, and then he asks about the, you know, the wages position. So he's picking on the major items there, and then he comes looking for any unusual items, and there it is. Look, bus advertising, $4,000, $4,000, $4,000. And the good news is that the grocer feels they've had the benefit of this advertising, so they've stopped this bus advertising contract, which means, as the bank manager pointed out straight away, instead of making a profit of around 8,000, if they do a similar performance in the shop, you know, that's before the expansion of the shop, you can add back that 4,000 because it's not going to be deducted as a cost to the business. So that brings, as the manager pointed out, the profit to around about $12,000, which is enough to cover the interest cost on the $56,000 loan, plus a bit of surplus towards the repayments, the capital repayments of the loan. So we'll have more on that on a moment, but is everybody okay on that approach so far before we start picking up some of the other things that he highlighted? Any comment on that, or are you comfortable with that? Come on, Candice, you usually have something to say. Is that okay so far? I wasn't being rude.
I was just reserving my comments
Yeah.
because I really didn't want to be the first to speak today. But
Why not?
I mean,
First speaker, that's fine. Miguel likes to do that sometimes when he's feeling that way inclined. Okay,
I
come on.
guess I don't know. For me, I liked it. I like how you said how he pointed out some stuff. I
Yeah.
saw the CIF came out, but
Yeah.
I mean, I guess as a banker, there was some stuff that he offered. I didn't see the real need for it, but I guess he's looking to make a profit as a banker. And
Yeah.
so as a certified financial planner, I probably would not have gone that way. Let's say like with the overdraft and all of that, but I like the pension, I
Yeah.
like the idea with him looking at the gentleman's cash flow, but trying to use all of it.
Yeah.
If he doesn't have to, I would not have agreed with that.
Okay. Right. Well, we'll come on to that next. So what we've got then is the enhancement of that. So it looks, it looks much more optimistic. I think you'll agree than the security clerk's approach, where he just kind of turned it down flat without getting in, to the sensitizing of the information. He was just taking, what was stated there. So looking at the balance sheet, you see the balance sheet is interesting in that, yes, the stock's increasing because, each year he's selling more. The receivables are increasing, but we saw, based on our ratio analysis sheet, and you did this as well, the debtor collection isn't anything to worry about because very quick, just 10 days, 10 to 11 days. So that's because most people are paying cash at the till. But the interesting point that the bank manager picked up on was the cash reserves that's in the bank. Now look at the increase here. It's gone from almost $7,000 to $15,000 to $22,000. So getting down to basics, what does that mean about the cash flow of this particular business? Now forget the clothing imports for the moment. We're going to come back on that later. But what does it tell us about the cash flow profile of this particular business? Anyone?
I think it tells us that he has the capacity to deal with probably short-term and long-term payments.
Good. Excellent. Why though? Why does he have the capacity? What is the business actually doing then? In very basic words.
Well, it's turning over and
Yeah.
it's only saving, it's heaping it up.
That's it. Yeah, that's what I'm looking for. There's two words that we often use when we're looking at cash flow profiling, as you'll discover. Some businesses, we can really describe them as cash consumers, yes? And then some businesses we can describe as cash generators. So that this business I would categorize as a cash generator. Why? Because of what you're seeing there and being retained in the balance sheet. So the bank manager is quite right. Maybe he doesn't need to borrow $56,000. Maybe he could take some cash out of there. And that would be a financial planning discussion because the amount that he might say, well, I don't want to take any of it out. I want to keep that as a reserve and I'd like to borrow the full 56,000. So he could say that, or he could maybe say, well, yes, but I'm, quite a conservative person. Maybe we could use 10,000 out of the 22, and drop the loan request to 46. So there is flexibility in the discussion on that aspect of the cash balance. Is everybody okay on that bit so far?
Mr. Checkley, you
Yes.
made a interesting point there when you talk about being a cash consumer,
Yes.
right? I would think being a cash consumer is a good thing, and maybe that's just me looking at it from a side view. But in that case, wouldn't you think then let's give him the full cash that he wants, and then maybe what we can probably even give him options, whereas you set the loan, you have the option to pay, let's say, principal payments, which will also impact the loan term.
Yes.
And at the end of the day, you got your loan, you still get to keep your cash.
Yeah.
Everybody still wins, rather than having him go into his reserve.
That's right. And another alternative as a financial planner would be to say, well, maybe you could take some of that 22,000 and put it into an investment product, yeah, to generate some income from the investment. So there's plenty of options there. Nothing is definite with this. All we're discussing is from the cash profile of the business. There is scope, if needed, or if the customer would like to use some of that cash balance, towards the purchase of the premises. So more on that in a moment. Now what happened on this case, the same as on the clothing imports case when we come back to it, and we talked before, about getting information and asking for more information and this, that, and the other, which we did with John Edwards and Jane Brown. Well, what we could also ask for on a case like this and on the clothing imports would be some type of cash flow analysis that the accountant could prepare. And what we've got on this case, which you've already seen attached to the ratio sheet, you'll see there's a cash flow worksheet. So let's turn our attention to the cash flow worksheet and see if that confirms, the thoughts that we've got so far and the bank manager's thoughts so far. So I'll just stop sharing this for a moment. And go back. Okay, now there's the ratios that we had, and here's the cash flow worksheet. Now we often get a question, and Miguel will often have this question to him as well. In the exam, will you be asked to prepare a cash flow worksheet? Now this is very important. The answer is no, you will not be expected to be able to prepare a cash flow worksheet like this. However, there may be questions where you'll be asked for an interpretation. So it's a good idea, that you're familiar with the cash flow worksheet. And for you, moving forward with your careers, it's really good if you've got an idea, where do these figures come from? Because if you know where the figures are coming from, you'll have a better understanding of what they actually mean, which is why, we spent a lot of time and hard effort, number crunching, getting those ratios out on this case and getting the ratios out on clothing imports, because I could have just given you those sheets. But the point is, as we've discovered many times, that if we just give you the figures, it's hard for you going forward, particularly in conversations with the clients, to get a feeling what these figures mean. And if you've done them yourself and extracted them yourself, you should get a better understanding. So let's take a look at the cash flow worksheet. Now, what you're going to need to do is something that's a bit tricky for me to do on the screen, but what you need alongside this, is the James the Grocer case study. And you can see what we're going to focus on is just that final year there. So if you go down to the bottom of the income statement, you'll see the opening point for the cash flow worksheet. And again, if this was a USA methodology, at the top there, instead of saying profit before interest and tax, you'd see EBIT, earnings before interest and tax. So it's worth making a note of that So, you know, if you get American set of accounts, you're not sort of clean bowled before you make a start. So everybody pick up that 7823 position. And then you'll see we add back depreciation.
1 second,
Uh,
Mr. Chatley, where you picked up the 7023 from?
from the income statement, bottom of the income statement. You got it?
No, I don't see it.
Well, you should do. It's in the final year there. You had the overhead costs.
Hold on, I'm sorry. Okay,
7113.
I see it.
Good.
I got
So you got that. Yeah. So
Mhm.
7823 is the entry point because it's profit before interest and tax, right? So that doesn't say net profit. Now this is important because you'll see when you look at any type of cash flow analyst work, you'll see that we don't start with the net profit. We'll start with either PBIT, which we're doing there, or some analysts will start with the profit before tax. But generally, most analysts will start with PBIT, profit before interest and tax, or EBIT. Now, the next thing is, can you see there's depreciation added back? So if you're looking at the same income statement, can you see depreciation there of 2150 and 1,000? So that's just
Yeah,
above, yeah, that's it. That's just above the overheads total of 71,113. So we're adding that back to give us what we generally call the gross operating cash flow. Now, anybody venture, why are we adding back depreciation? Now, the security clerk didn't understand depreciation. Do you understand what depreciation is? What, and why can we add it back in the cash flow? So it's deducted in the income statement, as you've seen, as a cost, but then we're adding it back in the cash flow. Why do we do that? Tricky question on a Saturday morning or any other time. Okay, we added back because depreciation is a non-cash item. Now, why is it a non-cash item? Because you never, you know, the business customer will never write a check out for depreciation, or he'll never, you know, use a credit card or a debit card for depreciation. It's actually a non-cash item, which, as you can see, is a charge. It's a debit against the income statement, but in terms of cash flow, it's a non-cash item. So we're entitled to add that back. And you'll see that on any cash flow analysis, depreciation will be an add back, you know, right at the top of the analyst sheet. And there could be other, can you see I've also got other non-cash items. Now, there aren't any on this particular case, but there could be, particularly when you're looking at some of the larger businesses, or for example, a business where they're trading some sort of foreign exchange instruments, they might make a gain because the foreign exchange market has moved, you know, in terms, for example, of the dollar versus the pound sterling. So there might be a gain or a loss that's recorded in the income statement, but actually, once again, it's a non-cash item because they've never written a check out, you know, for the depreciation movements in the currency there. So on this particular case, there's only that one item. 99 out of 100 businesses you look at, there's probably only going to be depreciation as an add back. Are you okay with that so far? First time you've seen it. Does it make sense? It's a charge against the income statement, but you know, it's not a cash item, you know, it's a non-cash item. So we added back in terms of the cash flow. Now, the good news about the cash flow analyst, whatever format it's in, and this is quite a frequently used format, when you get to the bottom there, can you see what I've got at the bottom there? Net movement in cash. And then I've put an asterisk, reconcile with the source documents. Now, this is the power of cash flow analysis. People will suggest, well, profit can be manipulated. Maybe through changing stock valuations, or maybe sales are overstated, or maybe some costs are understated. But the one thing about cash flow analysis is it's got to balance, because before the accountants can sign off the cash flow analysis, they've got to reconcile it with the source documents, which we'll do. So anything erroneous that we make in looking at this cash flow worksheet, when we get to the bottom, if we made a mistake, it's simply not going to balance. So we'll know, we've made a mistake somewhere. We won't know where the mistake is, but we'll know we've made a mistake somewhere. So here we go. We got gross operating cash flow of 10,973. And it's at this point where the bank manager, remember, he said, but of course, in addition to that, because the bus advert for 4,000 has not been charged, going forward, because the contract has ceased, based on last year's figures, you can add 4,000 onto that. So that's approximately 11,000 gross operating cash flow, plus the 4 gives you approximately 15,000 of cash flow, which is definitely sufficient to cover the 8,000 or so interest charge and capital repayments on the $56,000 loan. So I'm going to draw a breath there and just ask any questions so far before we get into the other bits of the cash flow analysis. I mean, are you comfortable with that calculation so far, which of course is different? Those of you who came on early and those of you who could hear Miguel saying, well, any financial planner who would grant James the grocer the loan should be fired. I bet you didn't hear him say that. He said the security clerk was dead right. But Miguel's got a good sense of humor, and he was only trying to tease us. I hope he was.
Mr. Chuckley, I mean,
Yes.
I don't want to hold the class up, but
No, of course you're not.
I seem to be having a challenge with my numbers trying to follow you,
come
especially
on.
when we started with the profit before tax. I know it's correct because I have it here written down, but I just can't seem to identify where you're getting all of the numbers from, because I'm looking at the balance.
Let me go back on and let me stop sharing the cash flow worksheet then. And go back to the income statement. Miguel, is there any way we can share the two things simultaneously? Or would you have to cut and paste it all?
Yes, we could probably they might be a little smaller, but we can get both of them on the screen. Hold on one second. I have it. Where's the chat? I think,
if you can get them
anyone
both.
see in the chat? I put some documents in the chat. I have, oh no.
Try and put them side by side.
I have what? I have James the Grocer ratios, or
Yeah. And then you should have James the Grocer from your major module document, where you've got everything together, the case study.
so this is the balance sheet here we're looking at, right? And then we need a cash flow. So we need the
No,
balance sheet, the cash flows side to side.
No, slow down a bit. If you go into the module documents that you send out where you've got all module 1, module 2, etc., and you've
Okay.
got the case studies, what we need from the case study section is the James the Grocer income statement, which you can see on the screen.
Income statement.
I can give you it. It's page 45 in your PDF file.
All right. And then you need the cash flow.
No, not yet. And then the balance sheet, which is probably page 46. There it is. Look.
It's the balance sheet here.
Yeah. So we want those 2 pages.
Side by side.
And we want the cash flow worksheet. So we need 3.
Oh boy, that might be a little challenging because.
Well, get trying it, idea.
Yeah, let's try it. Let's try it. I'll try it. Hold on, give me a second.
Okay, while he's trying that, then let's go. There's the income statement. Can you see that on the screen? Andres, yeah. So you're asking me where the figures come from. Well,
Yes, I can see it.
Yeah, there's the 7823. Look, the net profit before tax. Yes. So that's the opening figure on your cash flow worksheet.
Okay,
Right. And then we're going to add back any non-cash items, of which the most frequent, as I was saying, will be depreciation. Now, there's depreciation of the shop fittings, there's depreciation of the motor van, and you can see the total of those two together is $3,150. So that goes into your cash flow worksheet as an add back because it's non-cash items. So the start of your cash flow worksheet will be 7823 plus 3150, and that will give you line A, the gross operating cash flow of 10973. So almost $11,000. You got that?
yes,
Okay, now then, now if we stop there just for the moment, because there's other figures to follow, as you can see in the cash flow worksheet. But if we stop there for the moment, that's the point at which the bank manager stopped. And he said, well, the cash flow is approximately 11,000, but because the bus advert at $4,000, which again, you can see on the screen, bus advertising, that contract has terminated, so he won't have that deduction. So what you can do is add back 4,000. So instead of making a profit of, 7,823, if the figures were similar, you would make a profit of 7,823 plus the 4,000. So that's good news for the cash flow worksheet, because going back to your worksheet, you've got line A, gross operating cash flow 10973, and you can add back this extra $4,000 that he won't be spending on the bus adverts. So he has a cash flow of around about $15,000, which is a totally different approach to the security clerk who just said, oh, well, look, the best profit you've done, 7,823, and that's not enough to cover the interest on a $56,000 loan, let alone any capital repayments, and you just cut off the conversation at that point. Whereas the bank manager said, we don't judge a business, just on the profit figure alone. And that's what we're doing. We're going beyond the profit figure and looking at what actually pays the interest cost. Okay, it's charged in bookkeeping terms to the income statement, but in real life, any interest payment you pay out of your own cash flow, don't you? If you've got a car loan or something and the interest payment's due, you got to pay. And it's the same with the capital repayments, they'll be paid out of what cash flow you've got, what income you've got. So the cash flow will be a key measurement that we're looking at. So have you managed to do that, Miguel, or is it a bit too tricky?
I can only get 2 on a page, or if you want me to show it to you.
Yeah, let me see what you've got on the page, please. So I'll stop sharing. Okay, oh, that's good, yeah.
The cash flow is just below this, a bit down. Yeah.
Oh, yeah.
But I mean, can you see that it might be a little small?
No, don't worry about that. The cash flow is the one, that we've completed the figures on, which is attached to the ratio document.
All right.
But they're good to refer to. Can you make it a bit bigger though?
Yeah, let me see if I can get this little.
Because your
Hold on a
whole
second.
screen's quite small. Can you enlarge?
And I'm hoping that nobody's using their cell phone or a tablet for this class, because as I said, we
Okay, well, we've been going an
Yeah.
hour, so we're due a short break. So let's have a 5-minute break. And Miguel and I look at this screen sharing and see if we can get the worked cash flow sheet, on the same screen. Okay, so 5-minute break while you have a stretch your legs or make a cup of coffee or a cup of tea. Yeah, that's good, Miguel, but the whole screen, your Zoom screen is still quite small. You know, it's not like filling the whole screen. It's smaller still. Oh, well, that's gone bigger, but we can't see the two now. Yeah, I see what you're getting at. Okay, zoom out a bit, that's it. Yeah, okay, so there's the balance sheet and the income statement side by side. Now, is there any way we can get that cash flow worksheet that's in the chat box? Or would you just have to flip to it? So go into your chat box. Go in the chat box and open James the Grocer ratios, and you'll see the cash flows attached to that.
James goes to cash flow.
No, you're not in the main document now. What you're in now is what I sent you this morning to put in the
Yeah.
chat box. So you want James the Grocer ratios and the cash flows attached to that. So I think you'll have to stop sharing that for the moment and then go into your chat box.
I don't know why you can open it.
No, look. What's happened? Okay, I'll do it then. If you stop your share, I'll do it on mine.
Oh, yeah, try it. I don't. I mean, I just sent it to you this morning. There it is. Okay, I have the ratio sheet and the cash flow side by side. You want to see that?
Yeah, okay. I'll have to stop sharing then.
Yeah, stop sharing them. Is it what you're talking about?
Yeah, that's it. Yeah.
Make it bigger.
Yeah, we're finished with the ratios for the moment. So can you make the cash flow worksheet bigger? Not the ratios, the cash flow. Yeah, that's it. So there seems to be no way around it other than jiggling
Yeah,
between
the two
one and the
pages.
other.
Yeah, just because of the size of the screen.
Yeah.
Even if you try to get three on there, you won't be able to read three of them.
No.
And I have, to be honest with you, and I have a big screen. I have a 22-inch,
Yeah,
22-inch screen, and I'm pretty sure nobody else does.
yeah.
You guys just use maybe a 15-inch screen, or 19 or 21-inch screen.
Uh-huh. Okay, well, we're going to reconvene in a few minutes.
Right.
Okay, we're back on.
Okay, so
Okay, so you'll have to do a bit of juggling because the best we can do is 2 pages side by side. But you've got the documents, you've got the income statement, and you've got the balance sheets. And now what we're talking about, is the cash flow analysis. So we've done the ratios, you're comfortable with the ratios. And now what we're looking at is the final document, which is the cash flow analysis. So this isn't the cash flow forecast because the bank manager said, well, let's see if you can afford, the purchase of the adjoining premises without the benefit, of the new store being added. So what he's working on is the existing figures. As a final part of the case, what you would be able to say to the client is, well, can you work with your accountant or can you do it on your own if you feel you can? Give us a forecast, based on what you think the enlarged premises will do, bearing in mind the comment that you gave us that there's going to be this new office block with approximately 500 people in there. What do you think the incremental benefit will be to the store as it's enlarged? So whatever that benefit is going to be a bonus, in addition to what we've got here. So what we're trying to do is verify the bank manager's comment that he thought, that they could afford the store based on the existing performance. So that's why we keep going back to the income statement and the balance sheet. So Chandris, are you okay now with that opening part of the cash flow just before we progress a bit further?
Yes, I am, sir.
Great. So we've got this opening point of almost $11,000. And then remember that profit before interest and tax, which you can see at the top of Miguel's screen, of $7,823. That will be enhanced because the bus advertising will cease. So there's an extra $4,000 we can add on to there. And that will give us line A, which is the gross operating cash flow, whether you're using the international system or the American system. The GOCF, as it's often abbreviated, is the entry point of the cash flow. And the entry point is almost $11,000 plus the 4 will give approximately $15,000. And that's what the bank manager did, without producing any type of cash flow worksheet. He just gave you that figure. We're verifying the figure. Now, the next section of our work is we can take it a bit further than the bank manager did to really get a better understanding of the overall cash profile of this business. And I made the comment, a cash consumer or a cash generator. Now, unfortunately, and Miguel's sitting there quite relaxed, and I'm sure he won't mind saying, the problem Miguel and I both have had for many, many years is we're cash, Miguel, consumers. We're not generators, are we?
You got that right.
So, and then when we go back to clothing imports, I think before we go back to that, I'm sure you'll remember already that we suspect that clothing imports is a cash consumer. It's not like this grocery store business. And that's part of your job as a financial planner going forward. You need to get a really good understanding of the business that you're looking at in terms of sales and profits and the balance sheet, but also in terms of what type of cash flow does the business have. And this type of sheet, this type of worksheet will show you. So far we got positive entry at line A. Now the next bit is really tricky. So we were struggling with the other bit. We'll probably struggle with this bit. And this bit is really where it's worth you highlighting or underlining the word movements. So this is not the balance. I have to emphasize this is the movement, because if a business carries more stock or inventory, that will make a movement in the cash flow. Why? Because if you imagine you're James the grocer and you're going to have more inventory or more stock in your store, it's going to need cash flow one way or another to finance that extra level of inventory. So all these items you can see there, yes, we're going to pick them up from the balance sheet, but it's actually the movement. Now, this is where it gets tricky. So what I'm going to ask Miguel to do is, if he could put the balance sheet back on the screen, we'll look for these movements. So you should be looking at your cash flow worksheet. And you see the first item we're looking for is the movement in the stock or the inventory. And if you could just enlarge the balance sheet, Miguel, that would be great. Don't worry about the income statement, the balance sheet on the right there. If you drag it across. No, not the income statement, the balance sheet. That's it. Now can you, that's it. Make that a bit bigger if you can. Yeah, stop. That's it, right, great. Okay, now everybody look, we're looking for the movement in the stock or the inventory. And because we're working on the current year's figures, what we need to do, look, is look 1 year ago, and you can see the inventory is 24,817. That's the stock. And to get the movement, it goes up in the balance sheet to 33,724. So we're looking for the difference between those two. And I make that $8,907 that the stock has increased by. Now, when you carry more stock, you're going to need to finance that. So if we think in terms of the source of funds and the use of funds, when the stock increases, the business person will have to use funds. So that's going to actually use cash flow for the difference. So the difference is $8,907. And because it's a use, we're going to put it in brackets. Now, a few years ago, this was very confusing, but the accountants now globally have promised us, when you look at a cash flow worksheet, whatever format it takes, if it's a positive cash flow item, it'll just be stated. But if it's a negative cash flow item, because it's using cash flow, they'll put it in brackets. So on our worksheet, you should have on brackets for the stock 8907. We'll flip back to the cash flow worksheet in a minute after we've done the other two. Next one you can see is debtors on the cash flow worksheet. Same principle. If more people owe money to James the grocer, and they do, look, they owed $14,632, the debtors or receivables. That increased to $18,150. So more people owe money to the business. Now, when he collects those in, it will be a source of cash flow. But until he collects it in, he's got to use cash flow to finance that increased level of debtors or receivables. Now, I did warn you this bit's tricky. You've got to do it 3-4 times before you really get hold of it. So the difference this time between 14632 and 18150, I make 3518. And because again, it's a use of cash flow, that's in brackets. 2 more items and then we'll ask Miguel to go back to the cash flow. Now, creditors or payables. So these are the suppliers to the store. Now he owed the suppliers $54,897. Then in the current year, he owes his suppliers more. Why? Because presumably he's bought more in because he's selling more. So the difference this time between 54,897 and 66459 is 11552. But this time, because it's an increase in the creditors, so creditors are the business owing money to the suppliers. So if he owes more money to the suppliers, that's a temporary source of cash flow until he has to start paying it down. These are tricky, I did warn you. So this time it's a positive figure of 11,552. And then the final adjustment is the accrued expenses, where you do the same thing, the difference between the two. And then this time, because they paid it down, it's a use of cash flow of 802. So Miguel, if you could put the cash flow worksheet back on the screen, that'd be brilliant. Thanks. So that was the ratio and the cash flow worksheet. There we go. Okay, now everybody, you can see there, look, so we dealt with line A extensively. Then there's those movements we've been talking through with Miguel showing you the balance sheet. There's the items, look, 8907 in brackets because of the stock increase. Receivables in brackets because of the receivables increase, but relief by getting more credit from the suppliers of 11,552, which almost equates to those two negatives, as you can see. Then there's a small negative on accruals. And if you work the maths on those, you'll get line B, which is like a subtotal of that section we've been discussing there. So line B is the change in the working investment, or if you prefer the term, the change in the working capital. And you can see it's 1675 negative. So there's a small amount of cash flow tied up there within those movements there. So what we have to do next is, because that's a use of cash flow, because it's in brackets, we've got to take that 1675 away from our opening gross operating cash flow, and we're going to get what's known as net operating cash flow, which you can see is A plus or minus B, you know, depending on whether that's a positive figure or a negative figure. Practically every business you'll see will be a negative figure because they need working capital to keep the business going. So generally it'll be a deduction. But the good news is there's a net operating cash flow of $9,298. So he's still positive. I'm going to stop there and ask for questions.
Hi, Mr. Jeffrey, just a question. For the movements, is usually the previous year, that's the stock or the debtors or creditors.
Correct.
And
Because
the current year.
yeah, so if we were doing an analysis of the cash flows for that middle year that you've got, because you've got 3 years figures.
Right.
If we were doing it for the middle year, we would go back to the previous year to do those calculations, yeah?
Yeah, I only got confused with the creditors because for the third year,
Yeah.
for most of them, it was always an increase and we got the negative values. But then when it came to the creditors, somehow that one was positive. I have the amount, but I'm confused with direction.
Yeah, you will be. Now there are formulas where some textbooks will give you formulas that you can memorize, but I'm not in favor of that, because if you can figure it out properly by common sense, it means when you're discussing it with the client, you're not trying to figure out, oh, you know, what does this mean? Because you know what it means. So what you've got, see the formula could be, well, an increase in an asset, you know, will be a use of cash flow. A decrease in a liability will be a use of cash flow. You know, a decrease in an asset will be a source of cash flow, and an increase in liabilities will be a source of cash flow. But I find that extremely confusing. I think it's much better to try and think it through. Now, the best way, in my experience, to think it through is put yourself in the shoes of James the grocer, right? So imagine you are actually James the grocer, you're running this grocery store, and then try and imagine pictorial the things that's happening, and then ask yourself, as the owner, well, would that use my cash flow or not? So let's start again. So you're James the grocer, you've got a certain amount of stock in your store, and you decide, because you know, selling a bit more this coming year, my expectation is I'll be selling more. So I'm going to need more stock on the shelves. So to get more stock,
Yeah.
how can I do that? What's it going to need?
Cash to be used, so that, okay, if I do
Yeah.
that.
Yeah, and this is where it gets tricky when you first think of it, but you'll get used to it. Because if you're going to have more stock, you know, you've got to finance that extra level of stock. But of course, the twist in the story is when you start selling that stock, then it will generate cash flow, won't it? Because when people come to the till, you know, they'll pay. But until they come to the till and pay, you know, you've got to finance it and have it on the shelf. Candice has got another question.
Yes, sir, I need assistance. My movement, I understand the movement, I was able to work it out, but
Good.
I'm not getting it to balance when I look at the change in the working investment for
Why
the
not?
1675.
Well, I might have made a mistake, so let's check it together. So it's 8907 negative, yeah, 3518. Let's add the negatives together first. So 8907 plus 3518 plus 802. And then from that total, take away the positive as the creditors 11552. And I hope you get 1675 negative if you don't have made a mistake. Which I don't think I have because my cash flow balances. So Dimitri, you're very quiet today. You haven't said anything yet.
Okay, I got it now. Just a little half calculator, sorry.
So don't worry. It must be a
Yes.
Japanese
Sorry.
calculator. Yeah.
I got a late start, so I'm just trying to catch up.
Yeah, don't worry, Dimitri. I hope you're following it because this bit's really tricky, the cash flow. But the good news is Miguel's recorded it all. And then the other thing is we're gonna go, you know, back to clothing imports and look at clothing imports cash flow in the same way. So you know you'll get 2 bites at it this morning. Well, time permitting. Yeah, okay. So that's it. So we're still positive. That's good. Now there's no interest expense, remember, because he's got no debt. He's not paying a dividend out, so that's nothing there. There's no long-term debt at the moment, so there's nothing there. So line C is the net cash flow after debt servicing. Well, there isn't any debt servicing, so it's 9298. Fixed asset expenditure or disposals. If you look at the balance sheet, you'll see there's no movement other than the depreciation aspects. So he hasn't made any new purchases of fixed assets yet or selling any fixed assets. There is taxation. Now, tax is a bit tricky because it's a company, a limited company. The tax generally payable in this year's cash flow that we're looking at, because of the timing differences, the tax that's payable this year generally will be the tax assessment from the previous year. So if you're looking to see where I get 2568 from, you'll have to go into the income statement again. I'll let you try and find it rather than us switching screens again. So look at the income statement. Look at the sales, look right down at the costs, and
I
then look
see
at the
it.
profit. You've got it, brilliant. You can see there 2568 from the previous year for tax. So that's, you know, cash out. If you get a tax bill, you know you got to pay it. So line D, now this is the key line for you as financial planners and for business people, because it's at this line when we can ask the question, is the business a cash generator or a cash consumer? Now, other people might use other words, but they're quite basic words, which I quite like. You could maybe use cash positive or cash negative. I quite like cash consumer or cash generator. You can see James the grocer, as the bank manager pointed out, without doing all of this analysis, James the grocer is a cash generator. And there's the figure. Look, we've quantified it.
Please, sorry for interruption. What's the reason why he used the figure 2568?
Well, that's his tax bill from the previous year that he's got to pay.
It's okay.
You know, if you have tax, you have to pay it. With it being a limited company, it's generally a 1 year time scale. Now, the interesting thing about cash flow analysis, as I said earlier, is it's got to balance before the accountants can sign it off, and it's got to balance with the source documents, which is key. It's a key document for anybody involved in business analysis, because if you want me to manipulate an income statement, I can manipulate it in 2 or 3 or 4 ways, just like that. But one thing I can't manipulate, and Miguel knows this very well, as I do, you can't manipulate cash. You know, you've either got cash or you haven't got it, yeah? You know, so cash is a fact. It's not, you know, some accountancy creation. It's a fact. So let's look at this.
Excuse me, Mr.
Yeah.
Checkley, before you move on, just to pick up a question.
Yep.
Now, this tax here that we picked up, the 2568, that was
Yep.
1 year ago.
Yep.
But in the present year, there's a tax for $2,707.
Which
Why
you
not that tax? Because we would have already paid this tax.
No,
We-
no, it hasn't. It's only been deducted from the income statement as a tax assessment. So that's the tax assessment based on the year that we're looking at, and that tax assessment will be paid in the following year, yeah, because of the timing differences that are allowed with tax. And generally, you'll find this in lots of businesses you'll look at, that the tax assessment based on the income statement might not actually match, probably hardly ever matches the tax that's actually paid, because there might be some tax reliefs. You know, the government might give certain tax reliefs on certain things, or it could be, you know, due to items, different timings of items. So in this particular case, the tax paid in the current year will be the tax assessed from the previous year. Okay?
Mr. Chackley, I have a question. I know you
Uh-huh.
mentioned, I mean, you only can prove the movements based on a cash flow. But I know, and so some companies only submit like financial statements, like the income and a balance sheet, but they wouldn't submit a cash flow. Like,
No,
I don't
no,
know if by
yeah.
law or is that mandatory that they submit the cash flow
No.
with the statements?
It is not mandatory, but it's recommended under international accounting standards. As time moves on, we've always got like a balance sheet and an income statement, yeah, for many years. I'm trying to think when FRS 1 came in. It's quite a long time ago, because I did the book on cash flow in 2004. So it was before that the International Accounting Standards Board recommended that there should be 3 documents and not 2. There should be the income statement as before, there should be the balance sheet, and businesses and bankers and financiers would benefit from the inclusion of a cash flow. But the inclusion of the cash flow is not mandatory, it's a recommendation. So what you're seeing here with these cash flow worksheets is some of the extra information that, you know, we've been asking for on these particular cases. And same with clothing imports. If you remember, we were worried, we were seeing certain red flags that we were worried about the cash flow. So we would ask this extra cash flow information if it's not being provided. Does that answer your question? Okay.
Yeah, that answers it.
Now, if you go onto the internet and research, you know, Walmart or any other large company that you're interested in, or take a look at, you know, the, goodness me, Atlantis Group, on the large companies, you'll find it straight away. You'll find the balance sheet, you'll find income statements, and you'll definitely find a cash flow statement. But on smaller businesses, quite often you won't, which is why we often will need, you know, this worksheet prepared to help complete our analysis. So at line D, are they a cash generator or cash consumer? Well, you can see it's a cash generator because it's a positive figure, and we've quantified what the bank manager's expectations were that the business is generating cash flow, and we've actually put a figure on it. Now, as I said earlier, this has got to be balanced. So the only way it can be balanced is by these 3 items below. And I don't care how big the company is or how small, there's only ever these 3. If you want to write it on a bit of paper, the three are debt, equity, and cash. There's only those three. If a business gets to line D and it's negative, it's only got three ways of propping up the cash flow. Debt from debt providers, whatever form it might take. Equity from, new capital coming in, if anybody will put capital in, or cash from cash reserves. So let's see what's happened with the grocer. Well, there's no equity movement because we could see from the balance sheet the share capital was the same. There's no debt movement because there's no debt in this particular case. So the only movement can be cash. So he's generated cash flow. Where's it gone? It's got to have gone into the cash reserves. So keeping that figure in mind, 6730. Let's take a breath. It's like, making a recipe and making a cake. There's a final outcome. Let's get Miguel to put the balance sheet on the screen, and we're looking hopefully to balance our cash flow with that 6730 increase in cash reserves, I hope. Otherwise, I'm going to finish early and go down to Arawak Key if I was in Nassau. Have a quick beer with Miguel. Or the cricket club, if it's still there. So we're looking for that balance, the 6730. Miguel is keeping us waiting while he gets the balance sheet. It's coming now. Not the worksheet. We want the balance sheet. We don't want any of that, Miguel. You're on the wrong file now. Yeah, this is it. James the Grocer, you were there in the case study section. James the Grocer, you had the income statements, and then you had that's it. And the balance sheet just to the right on the screen. No, go back up. And then up to the balance sheet. There we are. Right, down a bit. So we can see the cash balance. There it is, look, everybody, current assets, cash and balance, and bank, sorry. So the bank manager pointed this out, that he was increasing his cash balances. And now we verified that by using the cash flow worksheet. Now let's see if we verified the right amount. So if the balance from 15,424 up to 22,154, if that represents an increase of $6,730, we've balanced the cash flow worksheet. So fingers crossed that we have, because if we haven't, I'm getting a bit fed up with this case study now. Anybody prove it? First one gets a gold star. Put it in the chat box. Come on, you must have done it by now. What we're looking for. Sophia, yes, it's the same. Brilliant. So there we have it. Look, we've balanced the cash flow worksheet. We proved that James the Grocer is cash positive, which you could say, somebody who's a really slick analyst might say, well, I don't know why you bothered with all that, because if I look at the balance sheet, I can see it's positive. Look, it's gone from 68757 to 15,424 to 22,154. So why do you need all this, palaver with this cash flow worksheet to prove it? Well, I think it's important to prove it because it's important to illustrate, right at that top line position, that line A, the gross operating cash flow, that he had sufficient there to cover the interest costs and capital reductions, even if he took the full $56,000 loan. And we can see there is capacity, not necessarily to take as much as that, as I was discussing earlier with Candice, but it would be, the customer's choice if they wanted to put some of that cash balance, that 22,154, into the project, in addition to the $30,000 which was coming in from the trust fund, you could maybe put in, another 10,000 or whatever from the cash balance on the basis that in the following year, provided things stay similar, which they should, then you'd be generating cash, to start restoring that cash balance again. So we spent a lot of time on that, but I hope that's helped you get an understanding of this particular case, James the grocer. So the answer would be yes. Yes, the collateral would be taken in terms, of security over the shop. The amount, 56,000 or whatever, would be subject to a discussion. So any other comments on it before we go back to clothing imports and have a look at his cash flows? Or if you want time to think about it, we could pick it up when we start next week.
I'm always a little off. I got 6,700 rather than the 6,730.
Well, what type of calculator have you got? Japanese or American or Chinese? It's probably a Chinese one.
Maybe.
Yeah. Well, everything's made in China, including these balloons they keep sending over, these spy balloons. You see that? President Biden's out in his back garden. He's got a new shotgun. He's trying to shoot down the balloons himself. The president of the USA. I shouldn't say too much. Forgot Miguel's recording it.
Got that right.
Got me into trouble before with President Obama and his new dog. In the White
Got
House,
it.
didn't you? Yeah, we got it. Great. We got it. Okay. Right. If you could stop sharing, Miguel, and I'll go to clothing imports. If I can find that. Right, now then. Clothing imports summary. Now, can you put this into that's not it. That's James the grocer. Oh, I should have stopped sharing that first. Sorry. Can you put clothing imports into the chat box if you haven't done so already?
Clothing imports summary ratios. I have it there.
Yeah. Good. Why is it not coming out mine? Why am I still seeing James the grocer when I don't want to?
Hold on, let me see. I don't know. I put that inside there, but
Have you stopped sharing?
yeah, I stopped sharing.
You sure?
You stop sharing. Let me open it up then.
Right, I've got it now. Can you see it now on the screen? Clothing imports. Everybody?
Yeah, that's still like James Grocer to me.
I'll stop sharing again. Have you stopped sharing?
Yeah, I've stopped sharing.
Right, let me try again. Clothing imports. Share. There we go. Can you see it now?
Yeah.
Dimitri, can you see that? Are you still there? Clothing imports, ratios. Or Candris or Sapphire or anyone?
Yes, I could see it.
Great. Okay, well, just to recap, I mean, we did all this before, but remember clothing imports, we were pleased with his sales growth, because he'd pushed sales up quite significantly. But I think you'd all agree that we weren't very happy with the rest because you had deteriorating gross profit, you had deteriorating net profit to a point where he was only making a very, very small profit indeed. Working capital didn't tell us very much. But then when we went to the efficiency, the data collection, he was collecting them in slightly better there, but then getting worse out to 65 days. And on questioning, we found, excuse me, he was granting his customers 1 month credit. That's 30 days credit. And it's taken him 65 days to collect it in. So that's very weak data collection. Stock days, remember, 61 days, 73, 78 days. We were quite concerned about that because it's fashion, it's clothing that he's importing. Quite worried that if we made a site visit, we might find some stock that's unsaleable. because it's out of fashion, or maybe some damaged goods or whatever. But certainly the stock activity is slowing, so that's a red flag. And then his payment to his suppliers, look at this, 63 days, 69, going out to 84. You know, that's a long period of time to pay your suppliers. And don't forget, he's importing these clothes. So the danger here is this is not a textbook exercise. If he pushes the suppliers too far, they might just stop supplying, you know, and then he's going to have no business other than the stock that he's already got to try and dispose of, but he won't be able to get any new purchases coming in. Interest cover, that's the cover of profits relative to the interest charges. That's got worse. It was okay before, but it's gone down to 1.2. Leverage is getting worse, up to 451% leveraged. And then the debt to equity ratio or gearing ratio, that's got worse. So he's carrying more debt relative to the equity. So I think we'd all agree, you know, looking at those on a snapshot of the ratios, the only really good news is the sales performance, and the rest indicates some quite worrying trends. So that's more or less where we got up to. Now, what we're going to look at is a document that you did not have. So this is the document. Once again, this is the cash flow worksheet. Now, this time I've done it for 2 years out of the 3 years that we've got there. And you can see the profit pickup from the income statement. Can we just start off, Miguel, by putting the income statement on the screen? I'll stop sharing. So this is clothing imports. It's in the case study section.
Hold on.
No, not the ratios, but the actual case document. It's in your big master file. You know, in the case study section.
Hold on 1 second.
In your big PDF file. Be around about page 50 something or 60. So folks, while Miguel's finding that, you need to find your own. We're going to need the income statements as before and the balance sheet.
Did you remember what page it was on? Because I can't even find this. Clothing imports, you said, right?
Yep. Anybody find it? Shout the page out.
In the manual, it's right after all of the balance sheets. You have the clothing limited and
Thank
the
you.
summary, and you would see the statement.
Hold on.
Look at page 14. Module 1.
Module 1, page 14. And in your PDF file, Miguel, it's page 27. So if you do a search, go page
Can you see my
27.
screen now?
I can see a screen, but it's blank. Okay, you're nearly there. That's it. That's it. Yeah, now go further up. Yeah, go up until you find the. Here we go. There's the balance sheets. So you start with. Go up again for the income statement, please. Okay, there. Stop. Stop. Okay, everybody. So what you can see is the entry point. The entry point for the cash flow. If we do the cash flow analysis for year 2 and year 3, which is the one, that I've done and completed, and Miguel's either emailed it to you or put it in the chat box. But I'm just trying to show you the starting point before we go into the cash flow worksheet. So can everybody see the cash flow starting point for year 2 will be, as we discussed, the profit before interest and tax, will be the opening top line. And you can see in year 2, it's $34,500. So that's the entry point. And then the cash flow worksheet for year 3, entry point will be $13,000. So that's the starting point. Okay, so if you stop sharing, Miguel, and then we can get back to putting the cash flow worksheet on the screen. Well, we would if I could find it. Where's it gone? Oh dear. It's disappeared just at the wrong time. Can you put the cash flow worksheet on the screen, Miguel? From the ratio thing I sent you. Ratios and cash flow. Clothing imports. Should be in the chat box. There. No, that's James the grocer. We want clothing imports. It's one of the 4 files I sent you this morning. Any luck? There we go, that's it. Okay, so we just want the cash flow worksheet enlarged if you can. No, not the ratios, that's it. This is what we want, yeah. Okay, everybody, so here we go. Look, $34,500, the entry point. And then the next year, 13,000. Then we do the same as before. We add back depreciation. In this particular case, it's $2,000. And then we do that summation, which we call line A, the gross operating cash flow. So you can see at a glance that in year 2, yes, clothing imports had a positive cash flow on entry point, but it deteriorated significantly in year 3 to only $15,000. But that's not the full picture. For us to see whether they're cash consumers or cash generators, we've got to get these other items. I'm not going to go through these blow by blow because you can do that later, but basically it's the same methodology. We look for the movements in the stock, movement in the debtors, movement in the creditors, and then you'll get, your summary of this section, which in year 2 is $35,000 negative. So he's used working capital, he's used working investment, and then the final year is used working investment at $27,000. So when you take line B away from line A, in year 2, he just made a surplus, look. So he had net operating cash flow of only $1,500, before his other payments. But in year 3, it's a bit of a disaster because he's used more cash flow in his working capital than he's actually got. So he's already negative $12,000. Now, I said earlier about, you know, when you pay the interest expense, when you pay tax, you paid out of cash flow. Now, in both years, you can see he's got a severe problem because look, there's the interest that's payable to the bank, $8,500, and he hasn't got the cash flow. He's only got cash flow of $1,500. So what that means is he's going to have to get cash flow from somewhere to pay the bank's interest charge. So there's no coverage in terms of cash flow. And then the following year, it's worse still. He's 12,000 negative, and he's got 11,000 of interest expense to pay. So, you know, our worry was that his cash flow management was not good. It was poor, showing warning signs, and this clearly illustrates it. So when you take that interest expense away from the net operating cash flow, you get line C, which is net cash flow after debt servicing, $7,000 negative, and then a whacking $23,000 negative. And then there's some other items. He's got some fixed asset expenditure and tax to pay. So when you factor in those items, there's his bottom line, where I asked you, and I said it's so important for the business person and for us. Line D, is he a cash consumer or cash generator? Well, you can see straight away in both those years, 2 and 3, he's a cash consumer, $14,000 he's short, and then the next year a whacking $35,000 short. Now, as I said earlier, the only way you can balance this is through those 3 items: debt, whatever format it might be, equity or new capital coming in, and cash from cash reserves. So let's see how he's managed to balance the books and continue to trade. Well, it's slightly misleading the way the computers generated this out, but increase in equity, that's actually 0. So I don't know quite where that figure's come from. If you look at the balance sheet, then if you look at the debt in the balance sheet, you can see short-term debt has increased, and then long-term debt has been a small reduction and then an increase. So what's happened is in both cases, the 14,000 negative was serviced by taking more debt. So therefore, there's no movement in equity and there's no movement in cash. You can see the cash is 0. And then this year here, 35,000 negative. That's all increase in debt from the balance sheet with a movement in cash of 0. So if we could just put the balance sheet on the screen for the final time, can you manage that, Miguel? Not the ratios, but the balance sheet, you know, from page whatever it was in the master file. You know, the big master file. That'll be the final time for today. One of the ladies said it was page 17, I think. Yeah, yeah. That's good. That's good. Okay, great. Okay, right, everybody. So look, there's the balance sheets. Don't forget, all financed by increase in debt. There's no increase in equity if you push it up, Miguel, to the bottom of the balance sheets. Can you see there? Look, there's no increase in the share capital. That's the equity position. It's steady at 20. So the only way he's been able to finance it is either by cash or by debt. So if we go to the top of the balance sheets, we'll see the cash. Can you see, everybody? Cash is 0, cash is 0, cash is 0. So he's got no cash reserves, which of course you'd expect. So the only way he's surviving is by taking more and more debt, which was illustrated, you know, in the debt gearing ratio. And if you go down a little bit, you can see there's the bank. You've gone too far. Go back up a bit. In the current liabilities, can you see there's the bank? Look, he owes the bank $90,000. then $105,000, and then $138,000. So he's borrowing more by way of overdraft. And then if we go further down, we'll see the long-term debt. There's the long-term debt. There's no long-term bank loans, but there's some long-term installment financing, possibly on a motor vehicle or whatever, and that's around $7,000. So the way he survived is by borrowing more. Now, hopefully Dimitri's still here, because when we did this case last week, after doing just the ratios, can you remember what you said, Dimitri? Where was clothing imports heading for? If you're still online.
I think he left. I don't see him.
Yeah, he must have left. Okay. Well, Dimitri made the comment, folks, if you remember, after we extracted the ratios, that if he has another year similar, he's going to go broke because he's in a mess. Yeah. And the cash flow illustrates that. So any hope for clothing imports? James the grocer, wasn't so bad. With a bit of more careful, deep analysis, we could see there was scope. What about clothing imports? Any scope for them to survive? Can you just go back to the income statement, Miguel? That's it, stop. So there's the trading. Look, 900,000, $1 million of clothes, 1.3 million. But look at that, year one, reasonable profit, 17,000. After paying interest of $8,000 and tax of $8,000, he still made a reasonable profit. Year two, he went up to over $1 million sales. But look, his profit actually went down a bit. And then year three, he must have worked really, really hard to get up to $1.3 million of sales, but he only makes $2,000 net on sales of 1.3 million. What sort of business is that? Anyone got any ideas? Last 5 minutes. Any ideas what he could do? Apart from, as Dimitri said, going broke. So if we're in discussion with them as financial planners, any ideas from that income statement or the balance sheets, if Miguel puts them back on? He just moves them up or down. Yeah, there we go. That's it, stop there. Thanks. Any scope you can see? So how could he make more profit? Any ideas? Second question, if you can't answer that, any scope for improving his cash flow? Because his cash flow is terribly negative at the moment. So what can you look at in the balance sheet that might possibly be some way of talking through that might improve the business? Okay, well, I'll leave that little puzzle with you. You can think about that during the week. And when we meet next week, we'll start off with a discussion with any ideas anybody's come up with, as a potential certified financial planner that you could offer in discussion with the clothing imports, any improvements that we can think of to discuss. Now, also next week, and Miguel is going to brief you on this, but what we normally do in this program is, because part of client relationship skills, sometimes, you'll have to make a presentation to clients, maybe on a new product that your institution's brought out, or maybe it's something different that you've got to present on. So what we usually ask you to do is a short presentation on the good news is any topic. So it could be a hobby that you have, it could be a financial product, something to do with your work, anything you want, but it's got to be maximum of 10 minutes because we got 8 people on the program, and without any breaks, 8 times 10 is 80 minutes. So Miguel will restrict you to 10 minutes. A few years ago, we had a lady from Abaco talking about making straw hats, which was really interesting, except it obviously takes longer than 10 minutes to make a straw hat. So we had to cut it down on the time. But anything you want to, or if you prefer, you can pick on Jane Brown case study, on the other guy that was in a bit of trouble, John Edwards, or you could pick on the grocery store, or if you're feeling brave, you could pick on clothing imports that we haven't finished off, or as I say, any hobby or anything to do, you know, with your work. Everybody clear on that? So next week when we meet, then we'll get stuck into clothing imports, discussion on improvements, and then we'll move into the presentations.
Yes, correct. So, ladies and gentlemen, we will require you for your presentations to have your, just to forewarn you, we will require you to have your camera on.
Yeah.
Okay? You can keep your microphone off until it's your turn, but we will require you to keep your camera on during your presentation and the other presentations. And usually, as Mr. Checkley says, usually I go first to show you
how badly it can be done.
how badly it can be done. Yes, yes. And I'm going to pick I'm going to pick James Grosser.
All right, great.
Why I wouldn't lend him £5.60.
$5, yeah. So you're still on it.
That's enough for him to catch the underground train to go back to where he came from. But anyway, so for those who missed this last end, I will brief them in it. But yeah, you can make your presentation on any topic that you want.
Any topic.
And as Checkley said, it has to be under 10 minutes. 10 minutes might
As a
seem
maximum.
long, but it's not.
Yeah. No,
Emails are very long-winded. You've had people go from 15 to 20 minutes like that, but no. Yeah, I will have to cut you off when it comes to 10 minutes, or we'll be until tomorrow, next week afternoon. Okay? So keep that in mind. So ladies, doll up. Get ready. We'll everybody will have their cameras on for next week. Okay?
so hope you're all okay.
Understood? We good?
Yeah, I think so.
Okay then.
Yes, we're good.
Okay, excellent. Yeah.
Okay.
So tough session on the cash flows. Difficult.
So we'll
Difficult. Yeah.
see you all next week. Have a good weekend.
Thanks for giving up your Saturday. And
Okay.
thanks for trying hard on the cash flows.
All right.
It's the hardest part of the whole program. Miguel will tell you that from experience.
Yeah.
Hardest part.
Okay.
No, actually, no. This. Oh, you mean cash flow? Yeah, cash flow is the hardest part. It is.
Miguel, just a question for you. If
Mhm.
I need some guidance, is it okay for me to give you a call?
That's not a problem. You all have my cell number. Take down my cell number. 437-6900.
Okay, thanks, Miguel.
All right.
Yeah,
Thanks.
So you see you all next week.
thanks. Thanks,
Okay.
Kendrick. Thank you, everybody.
Bye.
You stay on just a minute, Miguel.
No problem.
Thanks.
Good evening, good afternoon.
Good afternoon. Bye.
Yes, sir. Just me and you.
Yeah, that was good that you were in attendance today.
And I will be next week.
Yeah, so well done on the foundation level for the CSA.
Mhm.
That brochure looked good, and you think 9 minutes isn't too long. So the advanced level, I think you've got all the stuff for that.
Yeah,
from
that goes
before.
out next week.
Yeah, and then you could just build in the same introductory video because it just features.
The information about the Credit Skills Academy.
Yeah, and then the only other one that we need to think about working on is to come up with a separate flyer which would pick up on Cambodia's idea of trying to re-engage people on the CPD.
Yeah,
that's section-
definitely.
So that's section 2 of the academy. So we need to put something together on section 2, you know, what it contains. Well, you've got it already, you know, from what I sent, but I need to probably change the presentation to feature just section 2, do you think?
Yeah, so we could mark it out to everybody.
And then I can
These
put,
these accountants need CPD hours,
yeah, they do. And then what I can do is
like 500-600 of them.
I'm going to do an interview anyway with Keith Dickinson as one of the senior authors of the Credit Skills Library. I mentioned this to you already, and you said benefits would be good. So I'm going to chat with him and film it on Zoom, where we talk about what are the benefits of the Credit Skills Library, because that forms a major part of the CPD
Correct.
materials. So we could use that clip this time, I think.
Excellent idea.
Yeah, for the flyer for part 2. So try and get your brain around the flyer for part 2 when you get a chance.
I will.
All right with that?
Hmm?
Okay.
Yeah, man, we good.
Okay then.
All right, buddy.
Enjoy your Saturday afternoon.
You too.
Have a couple of beers on me. I'm going to go and get one now.
Yeah, okay then. All right.
Cheers. Cheers.
Bye.